Representatives from EU member states taking part in the banking union have signed an agreement on transferring finances and sharing them in a common fund to help out ailing banks. The fund's part of the so-called single resolution mechanism, which consists of a board of members who decide how to wind down or restructure banks that are no longer viable. Once regular financing options have been exhausted, the board could draw on the Single Resolution Fund, which will eventually total some €55 billion. This would help limit costs to average European citizens and the real economy.
No longer do the taxpayers bail out failing banks, but investors are bailed in, and that will change the rules of the game significantly.
The European Central Bank will act as a supervisor and early warning system, alerting the board if a bank's in trouble or likely to fail. Apart from helping to ward off any looming crisis, the mechanism's expected to boost economic growth as confidence grows that Europe's banks are all using the same rulebook. It would also sidestep the risks of contagion and avoid the problems involved in having national authorities wind down cross-border banks.
It's a very easy system, and you can compare it actually to how you organize your financial market domestically. You have one supervisor, you have one set of rules, which stabilizes expectations of investors, of consumers, of depositors. In practice, it requires a large set of rules, which sometimes are mathematical and sometimes organizational, but the principle itself, as we show here, is an easy one.
The single resolution mechanism will start going into operation on January 1st. It will apply to banks in the Eurozone and other EU member states that choose to join the banking union.